question. What type of asset allocation is favorable in this environment that both gives investors exposure to upside, but also gives them some downside protection as well?
Well, I think if you look back through time and you look at sort of over easy type macroeconomic environments, it typically favors hard assets, gold, commodities, stocks. You can think about in many ways as a hard asset since, it's tied to real economic cash flows and nominal GDP. And it disfavors things like bonds in particular, as essentially what's happening here is that by stimulating and supporting nominal GDP growth, you're eroding the value of money relative to stuff on a forward-looking basis. And so that's the basic story. So, when you look at most investors' portfolios, they're largely, most investors are overweight stocks and in general probably will do okay given that circumstance, although they might be overweight very, very highly valued stocks, at least in the US, whereas an over easy policy generally favors more of the unloved sectors of the market that catch up with the high performers as liquidity kind of goes everywhere rather than is concentrated in a very small number of performers. But they're probably overweight bonds in terms of assets that might protect them from whatever downside circumstance could plausibly occur. And so that's where I think, for most investors, gold becomes a more compelling option. And people snicker at gold and they say it's not yielding and things like that. But if you just look at the empirics, gold, first of all, is the best performing major asset class in the last couple of years and this year included. And second of all, gold outperforms bonds in about 50% of equity drawdowns. So just if you can put aside the snickering that it's, a barbarous relic, you can and start to think about just what its economic properties are, its return properties are. You should be holding as much gold in risk terms as you hold bonds in a standard portfolio.
Well, for those investors who are concerned about the fact that it doesn't yield anything, what about gold miners, which are, I believe, relatively cheap right now? Do you have a view on that at all?
Gold miners, I don't trade gold miners, and it's because I don't have any particular expertise in the companies. When you start to buy the miners, you're basically meaningfully exposed to the cost side of the equation, and those costs can move for reasons that have nothing to do with what's happening with the top line. And so in general, I like holding the asset directly. Its return properties are relatively well known. Its use as a alternative money has existed for thousands of years. And so it's a pretty well-known asset in terms of how it's likely to perform in various circumstances. And I'd particularly emphasize that to the extent that you believe that there is a rising risk of conflict, gold very directly outperforms bonds in those environments, both because of the inflation hedge properties, as well as the fact that it serves as an alternative money for investors that would otherwise be overweight dollars that might be antagonistic to U.S. interests.